Okay, hi guys. Figured I'd make this video to just talk about price action, talk about price movement a little more in detail. Um, I laid out the basic principles and the method, but just to try to take it to another level there and get into more understanding of price movement and what's pretty interesting. So let's start with. I don't have this really planned out, but I'm just going to go with it. We have this blank slate here. We have no background. We have no old information. We're starting with a fresh chart, okay, hypothetically. So let's take it. We have this could be any cycle: 5-minute, 15-minute, 1 hour, whatever. So we have this first move. Now, there's already a couple of things we can start thinking about. Believe it or not. First thing, obviously, some buying was initiated here. All right, we can see that, pretty obvious. All right, we'll start with that. Brought higher prices. There was demand. As price moved up now, we know that higher prices can bring supply. So, as price sort of probes into new territory with this hypothetical no background situation. So this new territory, we don't know if there's going to be a lot of selling here or really where sellers are interested and where those orders are already sitting looking to sell more and more with higher prices, as you would sell something at a high price. So if we look at this first move, let's say this is a first 15-minute or whatever, and that's our move. And this would be a candle that would close up near the top with no pin, right? So in this first move, we close solid near the top in this little cycle, and let's say we have whatever amount of volume on that. Okay, our starting point on that candle. So we have initiating buying and closing near the top. We can't compare the volume and say is it high or low yet, but close near the high. That's our information. We can say we haven't really seen any sell pressure. It was maintain that on the close, so the close of that cycle. So that's some information we can get already. Okay, hasn't really seen supply. So let's continue. The next candle, or the next cycle, we'll get this going on. Oh man, this mouse is so bad. Let me try that again. Next cycle begins. Got a move and then ends like that. So there's our next cycle. All right, what does this tell us? That there was a point where supply came in and selling overwhelmed the up move. So as far as we're talking about the balance of supply and demand, the demand caused this move, and then eventually the higher prices brought the supply, and that selling caused price to move down in order to accommodate that balance of supply and demand. Okay. So it's the imbalance there, tipping the balance towards more supply. All right. So we have this now. Let's say the volume on that would typically be higher. So this would be, let's say, a candle with a pin on top and that closed down. So typically you see higher volume because not only is there buying, but you're going to have selling going on. And you'll say, okay, why is there more volume still, though? Because over this period of time, seemed to move up and then move down. Okay, and this one, it just moved up. Why would we expect volume to be higher? Because there's a particular way, when supply starts to enter a bullish market, let's say, there's a particular way that it's done by professionals. They're not going to, let's say we have this up move, and the sellers increase their selling, or at least this price brings in selling to the point where it overwhelms. It's not, they're not looking to create a down move. They're not looking to, okay, so now we're just selling. at this point, and so we just sell, sell, sell. That's not how they work. They're going to continue to want higher prices to continue to sell. One opportunity to step in is not what they're looking for. They're looking to build a position. So selling here would be directly connected to the amount of buying. So there, in this area where it reverses, there goes on a activity of buying, selling, at the same time. You get that matching of the buy orders and the responsive selling. So this mouse is a pain in the ass. Okay. So that's going to give you the activity where, as long as price is moving up in this particular area, they're selling into, and they're happy to be capping price off at this point and selling. So as price can, with that demand going on, price can keep sort of knocking on that level and selling in response comes in. So that's going to create this, you'd see on a candle, price sort of bouncing up and down. And that's going to create more ticks. That's going to create the higher volume. So at this point, let's continue with it, and we can see that some of that ended up playing out in price. And now let's say of this up move, that could be a 50 retracement, 50 to 618 fib retracement there. And the reason why it may, there's also one other thing we can gather is it did stop at this point. It did end here. It didn't end below that fib level or above that particular spot. Now we know something about that particular spot, 50 to 618, is that's where buyers like to come in, during a bullish market, or if generally 50 to 618 on a pullback is going to have some buy orders. It's like no matter how bullish, how bearish you may be thinking something is, when you get to that 5618, you watch the 5-minute, it'll slow down, it'll hit some increased volume and have trouble getting through it. So just by the nature of how things work, computers, those buy orders came in here, and let's say stop the move at that point for a reason. That the demand came in to stop that and sort of balance it out and stop the down move. All right. So all this information from this little move. So let's keep going with it. Let's say now we do this. I know this is so sloppy, and I probably have some line or something. Yeah. Okay, that's better. Yeah, whatever. So the next move is that. And we'll put, oops. We'll just put some medium volume on that. Okay. So this tells us that the demand, remember our buyers initiated here, they were happy to buy at this price for whatever reason. And then let's say it came to that typical spot, 50 to 618 fib. The buyers came in and started to move price up again as the demand or the trend so far, you could say, or a markup is really being formed now, and the demand is overwhelming here, moving price up again. And you get to the point where you're going to get to this level again. That's the first thing. So we can compare that and say we were able to get through that, and the selling that was here is no longer there. No longer there in that large amount if it was able to get through that. Otherwise, you could end up with a double top. So this is looking very bullish now. So you may do a couple of pullbacks and continue trending upward with higher highs and higher lows. That would be typical, for a markup. So let's continue. Let's say the next candle or the next move in price is this. Let's see if I can clean that up. How's that? Okay. So now we have, let's bring that down. Now we have situation. Let's put some volume on it and say it's high volume. So in this bullish market, something happened here a little differently. Price accelerated faster and then reversed that move. So that would be what? A pin on top, a doji, if we're looking at candles. And the volume's very high. So we know that this could mark the end of the up move. But why? This climactic action, whether you want to attribute it to the herd trying to jump in on the trend or smart money using some sort of tactics one way or another to mark price up quickly, regardless of the exact cause. This is typical stuff you see every day in the market. So this rapid rise, already before you even see that reaction, before the candle closes in the high volume, the rapid rise in the middle of a move, now we're not talking about rapid rise off of there, in the middle of a move while it's already trending, that rapid rise is not a good sign for the trend anymore. That marks possible supply coming in. So, and you can think of it also as quickly moved up there rather than regular buying going on where it was manipulated one way or another, and that could happen on a news release. So one way or another manipulated up there where it didn't really belong, if you know what I mean, where if it had maybe moved slower, that it wouldn't have been able to get so high. So what does that do? It does trap a lot of traders in the wrong direction if they're going to look to go long here. But it gives sellers, smart money, a place to, first of all, take profit on the long here. They get that higher price than maybe they normally would have if it had gone slower. They really like to do this stuff on news releases too. Or, fake breakouts over a recent resistance. So they get that extra high price to take profit on the longs in this bullish little market here. First thing, okay. Also, if you're going to start selling, because we know, again, higher prices are going to bring supply. And to, sort of forcefully put it this high, you can expect some supply to have to be dealt with. Especially if you have profit taking on the demand along with that supply. Profit taking on demand, is basically supply. So you have, plus the higher prices. So you can run into some real weakness, and that could cause typically that down move. So now as far as the high volume, that's a lot of activity we just talked about. The manipulation, the profit taking on longs, the entry of short positions. The way I talked about before, that these short positions enter in a certain way where they're not immediately starting to mark down price. So you get this up, down as the buying comes in and the selling matches that. You get that extra tick activity. And then in this case, we end up closing this cycle back where we started. So that tells us that supply was really overwhelming. And so putting that information together, we can see this could be a top, this level. So just to see this rapid rise, already a warning sign goes off. Then to see, a reaction like that in the high volume, even before that candle would be done forming, you already get a warning sign, could be the end. All right, so the next thing, various things could happen. It could still continue up. You can still have this type of activity occur again. You can get a range set up where, all right, so let me think of the different things where I want to go with this, different directions it could go. Okay, let's say at this point it stops here, right? Not higher or lower. There's a point here. So the next candle opens up, the next cycle starts, and let's say we have a little up move and then a little move down. This mouse is so bad. I never use this mouse, but my wireless mouse batteries are dead, so okay. So we can already gather some things here. Let's just put some medium volume on this, whatever. So we can already start to gather some things from this level. If we're going to have selling coming in, supply, there is a level here where it did stop, and now the next candle, next cycle starts with an up move. So we know that there's some demand in here still. Maybe these are those thinking the trend's going to continue. Maybe simply the fact that the lower prices can bring demand. So it moved down and to an area where it was able to move up from before, and these lower prices could bring a little more demand. So you get the little up move. And if they're looking to sell, and smart money is getting short-sided, buyers short or positions short, they're not going to immediately get in and look to mark down price fast. They, again, like I was explaining, those higher prices they want to sell into and try to let the market come back and give them that again or more. So that's distribution. So in this case, it moves up, and maybe some selling a little more aggressively comes in at this point and stops the move a little earlier, and you have a little pullback there from it. So now at this point, very often you'll get a range. So typically, let's say the next candle moves up near the high, you get this sort of reaction again. My lines are so bad. So that could show you again, and now let's say that would be some increased volume. So having price move up off of some demand that's able to hold up price against that weakness, and then to have a supply hit again, higher prices where they were before, and a reaction to that. So you can have this range where the profit taking on the longs, the positioning short that goes on. This is distribution phase basically, right? So let's see, how would it end? Let's say you can have a couple of things go on. I won't draw this, but let's say you can have and typically on a news release, but really could happen anytime during regular market hours. Be looking for you could have possibly a fake break above here, so popping above that price. Again, a manipulated move, pop up there. You see the high volume and the reaction. Again, higher prices bring that supply, and that high volume should be there. Okay. Another situation is, again, we knew that there was some buying in here, enough to hold it up against that weakness. Weakness shows up there, and then we're at that level again. So let's say we get instead at that level a no demand. So that would look like this. I don't even know why I draw that squiggly. Let's say it looks like that, because the no demand would be a candle that moves up but does not close at the high, and a small body, and of course low volume, lower than the previous two. There's my no demand. So what does that tell you? This, before I had demand, and there was enough to create this range, right? So you see where I'm going. If the demand is here, and then it shows no demand, meaning the up move is very small, the volume is very low, it closes off the high. What is that going to tell you as a seller now that we've known that smart money took profit on the long and they've been positioning short? So as a seller, what is that going to tell you when the level of demand here is giving you a no demand, showing you lack of demand? Now, why is that volume so low? Why can we count on that stuff happening? Because we know that they're looking to sell up here. So sellers aren't going on there, low volume, and buyers aren't going on there. Not enough, barely. So this no demand is telling these sellers you're not going to get this price again. So what does that mean? Very important point. They're switching over their activity. They're switching. The computers switch over. The price was moving up. That's when they wanted to sell. They're not going to get that anymore. Now it's time to go. Now they want to mark down price. So they're not going to be looking to, sell into up moves. So let's say this is a no demand. Our no demand confirms, right? And I understand why. That the sellers at that point are going in now and looking to close this candle down, make progress, and make profit. So this candle closes down, let's say, medium volume. We already had the no demand. That confirms the no demand. And then, so from there, we have a real imbalance of supply and demand. We have supply, a lack of demand proven, and price should continue down until it runs into demand. This is, of course, a good point to get in on a short. So, again, rather than selling into up moves, they're looking to mark down price, meaning, like, again, you know, they sell into the up move here, but they're not really looking to create downward moves and make lower lows and all that stuff. In this case, they are. So you'd be looking for towards the candle close, let's say on the cycle, whatever this is, the 5-minute, 15-minute, 1 hour, that towards the end, it'd be pushing down and closing solid on the bottom, not large pins on the bottom. And also not a lot of volume would be seen. Let's say we have this stuff go on. Not a lot of volume would be seen now in this area because we're still don't have that overwhelming demand yet. We want to see supply just bringing price down. If there's a lot of volume on it, it could already be running into demand and getting that tick activity and, you know, sort of messing up that situation. So let's say we move down after that no demand. Lower prices brought some demand, enough for a little bounce. And what typically is going to happen, it's worth pointing out because it happens often, is that you'll get a test of this level. So it's the old, you know, support becomes resistance. But again, it was a level of demand. So if it's tested here and it does a low volume test and you see a no demand test of that level, and then you can continue down. That's typical. And that would be a good place to enter the trade too, a no demand test of this old demand level. I drew it kind of low, but line up there. Continue down. And then, so we're in markdown. And then you want to look left, as we say. This is an area where demand may show up. So if you were in this short, you might want to have that as a target. What have I created here? Let's see. So, you know, always looking left. So there, we did the cycle, and, you know, it looks like the old Wyckoff chart. But, you know, this can happen. It happens fractally, and, you know, computers are doing this and creating such order. So, you know, in this case, we started with no background, so now we have a background established. So trading forward, you know, if you were taking longs, you'd see what would happen here if you have possibly more supply come in and all that. So I think this was pretty cool. But one of the main points I want to make sure to make is that we really understand the phases and how smart money works. They accumulate, they mark up, they distribute, they mark down, or they accumulate, re-accumulate, continue the markup. But how they actually really act, you know, how they operate, and you can see the price action and the volume really confirming that. But the main point I want to make is that they treat price differently. These candles form differently. They enter the market and place their orders differently based on these phases, so you can really identify it and that point of switching over. So again, I can't stress it enough. Higher prices is going to bring the selling, the wick on top, you know, the up thrust, the fake breakouts, the pins, double tops. That's because they want those high prices to sell into. It's not trending downward yet. Once there's no more buying to give them that, and that's why the no demand is so good. Once there's no more buying to give them those high prices, they switch over. All the equations and the mathematical stuff, whatever these very advanced computers are doing, and they're mostly computers, and which is good because they repeat things and they keep things clean. They're recognizing the lack of demand and now operating in a different way, where we want to mark down price. We want those candles to close down. We want to keep pushing. We want to get going, and we want the herd to even join in our direction. We want to create momentum. We want to create lower lows. So if any demand shows up, maybe we'll kick it up and push through that demand and become more aggressive. So that explains and if you watch, most of the time I'm watching the 5 minute, but in the context of the 1 hour, of course. And if you watch the price action on the 5 minute, just try to read that stuff, and you'll start to see. You have variations on that. Let's say, price comes down here and it runs into some high volume demand. And you have yourselves a little situation where there's demand and supply pretty close together. That stuff has to work itself out. That would be a time where you may get a range and it's time to back off and let it work itself out. This is just one scenario here, but hopefully this just kind of makes things a lot clearer when you're looking at the chart and trying to figure what's going on. So remember, how the smart money operates and these type of principles and all that. So hopefully this was helpful, and I guess this video was a good idea. I'll watch it now and see if it's any good. All right. Thanks for watching.